Okay, let's bring in Mira Pandit now of JP Morgan Asset Management as we extend the conversation. Welcome. It's nice to have you here as well. You said in terms of sectors that tech is in for a quote unquote reality check. What does that mean?
Tech has been a big driver of the rally so far this year because people think, okay, well, the expectation for rates is moving lower. If we see a recession, tech was very defensive during the last recession. I think those things can be true, and there are some macro underpinnings for a bit of a tech rally, but probably not as much as we've seen, especially because as we start to see earnings from a tech perspective, that's where you get the reality check that they are still undergoing some of these challenges from a pricing standpoint, from a wage standpoint. There's still a lot of tough decisions to be made. And when you pair that micro story in with the macro story, all of a sudden you start to see a little bit of weakness in areas that perhaps wasn't justified in some of the run-up we've seen. Unless
we're reminded, like, for example, Dan Ives would talk today from Wedbush that, they're going to be cautious, but they're going to be more stable. And maybe more stable than other parts of the market and more stable than people even expect that they would be in this space, which is the reason why money's going to continue to go there.
Then people have to understand that stability is not necessarily growth. You can't have both. If it's going to be stable and more defensive in the next recession, then perhaps, yes, these are good blue chip quality companies. But if we're thinking about the growth rates that we had seen over the last decade or so, not likely to be replicated. So we have to be a little bit more balanced there. And again, I do worry a little bit about valuations, and I worry about concentration risk. People already have a whole lot of exposure to some of these very large companies. If you just own the index, you have almost 30% exposure to some of the largest tech companies, and yet the profitability is not commensurate to that same weighting. You maybe have 20% of the profits in the S&P 500 coming from those largest tech companies. So that used to be a bit more balanced a few years ago when they had gangbusters profits. We're not seeing that today, so we have to manage that concentration risk.
You want to stay defensive overall? It sounds like you're defensive. Sounds like you're cautious on the market.
Within the scope of the U.S. equity market, somewhat more defensive. If you want a little bit of cyclical exposure, I think that energy can still hold up when we think about profits because oil prices are still high. They have stabilized at a higher level. So those are some of the areas that we would find more interesting from a cyclical perspective. But I think defensives is going to be a good place to be. Healthcare, where you still have some access to those longer-term growth themes. And then looking outside of the U.S. to international stocks, where we're starting to see maybe perhaps more earnings upgrades than downgrades versus the U.S.
Okay, so you guys largely agree, sounds. But what about that?
Here's some tech I'll own. I mean, you got to own some. I think you can own small cap software. Okay.
Why?
Well, EV to gross profit, which is how most of them are valued, enterprise value to gross profit. The multiples have come down massively. There's a number of public companies, 5 billion or larger market cap, that are forecasted to have gross profit growth of 30-40% this year. If they don't outperform, if the EV stays flat, they're going to look very cheap versus history. And you've got big private companies that already have the money on the sidelines. They did Momentum, Qualtrics, Coupa. You're starting to see some deal flow in that range. And so maybe this sort of slower market in tech venture means it's harder to fund newer businesses, and some of these guys can actually do okay. So I think you can own some of those. I mean, you can't own nothing. I'm saying.
No, I know that. But if there's let's say if there's a broader economic slowdown, aren't the smaller enterprise companies going to get hit harder than the large ones?
Yeah, I think. So the question, yes, is how much is in the price, right? Like there's been a massive reset. I think the point that you made was a good one. Microsoft's a great company, trades at 31 times forward earnings, where the estimates are probably too high. So it's about like what's in the price. I'm saying some of these things have been reset massively, and you know the names of the companies that are coming in, buying them at 30-40% premiums. So I don't know if I can dream there's a 30-40% premium coming in the next 6-12 months for one of the mega cap techs. I think you own it for risk management purposes, and I get it. You don't want to be way underweight the Apple and Microsoft, Google, Meta in the index. But if you're really looking for alpha, not risk management, I think you take a shot with some of these guys where you buy a basket of them and some of them get taken out.